topics. Subscribe to the channel and click the bell icon if you don't want to miss out on our invaluable content. As always, everything said in this video is all with educational purposes only and should not be considered to be financial advice. Before we start explaining the most important economic concepts, it is important for you to know that the main current driver for the economy are the decisions made by the central banks. They decide the monetary policy, and this monetary policy is decided by two factors. The first factor is the quantity of the money creation, or in other words, the amount of printed money, and the second monetary policy factor is the rate of the main interest rate. The main interest rate decides the cost of borrowing capital, and it is more important than the money being printed, because the newly printed money is distributed to the public as debt, and if the cost for this debt is high, no one would borrow. And as Ray Dalio explains, today economies are driven by debt creation, hence if debt is not being issued and borrowed, there would be no economic growth. The principle is simple. Let's take the Fed for example. When they push their rates higher, this makes all debt more expensive. Debts like mortgages, car loans, personal loans, the rates on credit cards go up and so on. Those higher interest rate payments make it so that people get discouraged from borrowing more money, and because credit is what drives the growth, the economy stops growing, and not only that people stop borrowing, the ones with outstanding debts start repaying much faster those debts, and this drives savings down, and this drives the savings of the people downwards, which in turn makes it so that people stop spending. And when one person's spending is another person's income, so does the domino effect start. The problems in today's world can be seen if we see the chart of the effective Federal Reserves. Today we're on a record low compared to historical levels, and the big problem is that now is the first time since the 1980s when the Federal Reserve needs to hike rates in times of a weakening economy. The last 5 recessions that happened in the United States were saved via a lowering of the main interest rate, which in turn increases the debt expansion or credit expansion and makes it so that artificially the growth of the economy is boosted. The problem with this artificially controlled system is that over time the debts of the economy are constantly rising, and every time in history this money printing and those artificial interest rates led to a massive inflationary crash, with almost all assets dropping significantly in prices. Watch until the end of the video to see which asset classes perform the best during inflationary times, which are accompanied by a slowed growth. In economic terms, those times are called stagflationary times. In easy terms, stagflation is when we have high inflation coupled with high unemployment. The first time when the world experienced stagflation was in the 70s, and the 70s high inflation and high unemployment broke the so-called Phillips curve, which previously was taught as one of the main economic theories, explaining that inflation and unemployment are anti-correlated. The belief was that moderate inflation could be only good for the economy because it stimulated credit expansion, people were spending more, and we had increases in prices of goods and assets. The problem came when people started to lose their jobs in the 70s, and due to the increased printing that started after 1971, when President Richard Nixon removed the gold standard, which limited the money printing of the Fed. This event was followed by an increase in the inflation rate, and the peak of the misery was in the 1980s. The higher the stagflation, the higher the so-called misery index, which tracks the severity of the stagflation. It is calculated when we take the sum of the inflation plus the unemployment rate. Unsurprisingly, the most miserable years on record was during the Great Depression. The misery index reached 25.7% in the first year of Franklin Roosevelt's presidency. The index fell to only 3.5% by 1944, likely due to the full employment during the Second World War. Richard Nixon and Jimmy Carter have the bad luck of presiding over the most miserable economies of the post-war period, with the misery index reaching 20% under Nixon and 22% under Carter. Misery fell sharply under Ronald Reagan and continued to trend downwards during the Bush and Clinton presidencies. The current economic model does not allow for the next recession to be fixed with lowering of the main interest rate due to the fact it is already on a historical low, and the current inflationary problem could be fixed only with an increase of the main interest rate. But the problem is the record amount of debt and the inability for these debts to be repaid with significantly higher interest rates makes it so that the system is broken. Just so that you can visualize the severity of the debt problem, take a look at this next chart. Provided by Incrementum, we can see how the debt has grown faster in only two prior periods, in the 40s and the 70s. Each time epoch states how long did it take for the debt to double. The frightening part is that the last doubling of the total debt has happened recently, and in just 7.67 years. We doubled the total debt accumulated for the last 110 plus years, which is absolutely mind-blowing and quite insane from a historical context. This is why the Fed and other central banks in developed countries like the European Central Bank, Bank of England, Reserve Bank of Australia and many others are between a rock and a hard place, and everywhere they look, problems will arise. This is what comes after a historical creation and expansion of the money supply. So, in the following recession, we will have monetary tightening, which means no more money printing and higher interest rate levels accompanied with high levels of inflation. This will make it so that businesses will need to make higher debt payments, and they must cut costs and lower their expected future growth plans. This will lower the economic output and increase the unemployment, because one of the first places businesses cut costs is from their labor force. As the great Stanley Druckenmiller states, these times are without a historical analog, and if we study history, we'll see that the inflationary levels, which are above 5%, could only be stopped if the effective funds rate goes above the inflation rate level, which in today's world is quite impossible due to the enormous amount of debt. In times of monetary tightening during stagflationary periods, almost all asset classes fall in value, but there were exceptions in the 70s, and now we'll examine them. From 1959 to 1971 was the first sign of a stagflationary period. Then the second such period was from 73 until 75, after that from 79 to 81, and then from Q1 of 82 until the Q1 of 83 was the last such period of high inflation coupled with high unemployment. First, we must explain the difference between real and nominal return. Nominal returns are not adjusted for inflation, while the real rate of return is found when the nominal return is subtracted with the inflation number. For example, in the case of the S&P 500 index, on average for all of those periods, the yearly nominal return is estimated at 20.8%, but the average yearly inflation for the period was 13.8%. This means that the average real return is 7%. We must look mostly at the real return, because if we made 20% this year, for example, from our investments, but the prices for all goods and services also went up by 20%, then in real terms our purchasing power has not increased and it is on a net zero basis. When examining the real returns for the dollar, we see that it averages 0.1%, which basically is net even. The S&P 500 GSCI index, which translates to the Goldman Sachs Commodity Index, which is a basket of all the different commodities, and on average, the real return is a negative 1.5%. The worst performing assets for these periods were the base metals like copper, aluminum, zinc, iron, and others, with a negative real return of 15.5%. And the industrial commodities fell drastically during those periods with a negative 16.8%. The two best performing assets were gold, silver, and oil, with oil being the clear winner with a massive 64.3% annualized real return, while gold had a 24.9% real return and silver had a 13.1% real return. There is an economic saying which states that the longer we can see into the past, the longer we can see into the future. This is because everything is based on cycles, and the cycles do not repeat, but they rhyme quite closely. For those of you who want to enhance your returns, you could try and play the stock picking world, where you try and pick individual stocks from the gold, silver, or oil markets. This will enhance your returns because when the price of the underlying commodity that is being mined or extracted goes up in value, the certain miner or oil extractor makes a multiple on his profit, which as a percentage drives the stock price much higher compared to the percentage change in the underlying commodity. Let's explain this with more detail. Let's take a gold miner for example, and gold, and let's take two people, Peter and Jane. Peter decides to buy gold while Jane decides to buy a stock in a gold miner. The current prices of an ounce of gold, let's say, are $1,200, and currently the average AISC costs for the mining industry is around $1,000. AICS is an acronym for all-in sustaining costs, and this is the amount it costs the miners on average to mine 1 gold ounce out of the ground. And we know that the miner is mining 1 million ounces of gold per year. This means the profit is 200 million. Because $200 is the profit per ounce, 1 million ounces are mined, hence a profit of 200 million is made. Let's say now that tomorrow the price of gold jumps by 20%. Peter will make a 20% profit because the gold price went from 1,200 to 1,440. But how much will Jane make from her investment in the gold miner? Well, in the case of the gold miner, the AISC cost stays the same, but the only difference is they are not making 200 million, but they are making 440 million, which is an increase of 120%, and hence the stock will at least do a double up. But what happens in a situation like this is that the hype around the market and the profits that are being generated push the prices of the miner much higher than the actual change in the fundamentals, because markets work based on fear and greed. Very few are the times when the market is efficient and in a true equilibrium state. We covered truly a lot of information, and with this we end the video. Subscribe to the channel if you don't want to miss out on our content, and we have huge upcoming plans and videos. Check out our other content on the channel. Thank you for watching until the end, and I'll see you in the next video.